Inflation is coming. In September of 2020, the Federal Reserve reaffirmed its commitment to achieve maximum employment and inflation at a rate of at least 2% over the long run. But for many investors and consumers alike, there is greater concern about inflation ramping up coming out of the pandemic. The price of gasoline was up 22.5% since a year ago. The price of groceries was up 3.5% from 2020, and similarly, the cost of restaurant purchases saw a 3.4% spike over the past year. Combined with the trillions of dollars of fiscal stimulus packages meant to jumpstart the economy, the Federal Reserve has added 25% to the total supply of US dollars just within the last 15 months. Is this the beginning of an inflation run, and how can we hedge our financial resources against inflation? Hey guys, this is Nick with Nick Does DJI, and welcome back to my channel. In today's video, I want to go over how you too can beat inflation. Don't forget to hit that like button and let's get started. What is inflation? In the simplest terms, inflation is an ongoing measure of rising prices of goods and services, eroding the dollar's purchasing power over time. It's what makes your $1 today be worth 98 cents next year. With inflation, everything from a carton of eggs to a gallon of gas will cost more next year than it does today. And that's why you have your grandparents telling you how in 1965, a hamburger cost 15 cents or a brand new Mustang cost $2,368. The rate of inflation varies from year to year and is largely determined by economic factors such as the Federal Reserve interest rates and Consumer Price Index or CPI. But the rate of inflation at which it has risen has not always been consistent. While inflation has hovered around 2% since 2010, it was also not too long ago when we saw rates at 8, 10, 12+% during the 1970s and 1980s. And with trillions of dollars recently printed by the Federal Reserve, many investors are worried about rising inflation rates and where to park their money. During historic periods of high inflation, people used to park their money in bank savings accounts. In the mid-1980s, it was not uncommon to see savings account that paid out a 10 to 12% yield on your money without the downside risk of the stock market. However, as interest rates dropped to historic lows, saving account yields have likewise bottomed out. At the time of this recording, interest yields at traditional retail banks top out at 0.05% APY, and quote-unquote high-yield saving accounts like Marcus by Goldman Sachs and Ally Bank top out at 0.5% APY, trailing behind a 2 to 3% inflation rate. This means that if you had parked $10,000 in a high-yield savings account yielding 0.5%, you would have earned $50 in interest after 1 year. However, due to inflation assumed at 2.5%, your $10,000 will have actually lost $250 of purchasing power the following year. Don't get me wrong, a basic savings account is the preferred place for your emergency fund in case of any expenses that might come up. However, any amount beyond that is losing value to inflation and poor financial planning. So how should we allocate our money to make sure we beat inflation moving forward? Based on risk tolerance involving the most risk to the least, I will go over 3 different kinds of investments that might help you hedge against inflation. The key is to make your money gain more money through capital growth of assets over long time horizons. First investment to beat inflation is by, of course, investing in the stock market. Adjusted for inflation, the stock market has consistently returned an annualized rate of 8 to 10%, and it's not hard to see why. The stock market has been one of the greatest wealth creators for millions of households, and many continue to rely on the stock market for their retirement funds. And especially during this past year, with tons of cash on hand and nowhere to spend it due to the lockdowns and quarantine, investors have put more money into stocks in the last 5 months than the previous 12 years combined. Whether or not the stock market is considered a bubble will be left for another video, but one thing is clear, investors are desperate to park their money anywhere in search of growth. Investing in the stock market is definitely the riskiest out of the investments mentioned today, as we have seen from the 31% market crash back in March of 2020. However, investing in stocks is a long-term agenda where time in the market beats timing the market, and staying invested over the long run will allow your money to take advantage of compound interest and dividend reinvestment. And as long as you are not within a few years of retirement, I would personally allocate a higher percentage of my own money into the stock market. The second investment to beat inflation is by investing in real estate. When interest rates are low, the cost of attaining mortgages are lower and making the cost of borrowing more affordable in the long run. The monthly payments you lock in for 15 and 30 years will remain the exact same each month, but due to inflation, the value of those future payments will be diminished. For example, if your 30-year fixed mortgage costs $1,500 a month, you will still be paying $1,500 a month in 2050. However, say your current take-home income of $4,000 increases to $8,000, thus making the value of that payment less as time goes on. One of the most beneficial aspects of real estate is asset appreciation. On average, property values appreciate 3 to 5% annually, certainly more in desirable housing markets. We have already seen how hot markets have been in secondary areas like Texas, Arizona, and Idaho this past year. And even in my suburb community outside of Los Angeles, my home has appreciated over 6% during the 6 months since my wife and I purchased it. Not only are you benefiting from asset appreciation, but you, the property owner, also benefit from increasing rents. In many instances, annual rent increases are baked into multi-year lease agreements and oftentimes tied to the CPI inflation index. In my line of work in commercial real estate, many of our multi-year leases have automatic 2 to 3% rent increases built in. Last, by owning real estate, you can take advantage of generous tax write-offs and deductions only afforded to real estate investors. For example, real estate investors can write off the depreciation value of the property over 27.5 years if residential, interest on mortgage payments, property taxes and insurance, costs of certain repairs, and maintenance fees to maintain the property. The end result, however, is a much lower taxable income while allowing you to keep actual cash flow in your pockets. These rules can get pretty complicated, so please do contact a licensed tax professional if applicable to you. The third investment to beat inflation is by taking the most conservative approach and investing in Treasury Inflation Protected Securities, or TIPS. TIPS are bonds indexed to inflation that are issued and backed by the full faith of the United States government, making it a low market risk investment. TIPS pay interest twice a year based on a fixed rate, and principal value are adjusted on inflation as measured by the CPI, thus making it no risk to inflation. TIPS may be purchased directly from the government through Treasury Direct or through stock market ETFs like ticker symbol VTIP, TIPS, and SCHP. But by no means are TIPS designed to outperform the S&P 500 or any stock market indices, but having a small allocation combined with other asset classes provides some protection and stability against inflation. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. And if you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on all the latest videos. The YouTube algorithm likes these sorts of engagements and helps my channel get shown on more pages. Until next time, take care.